Hash why your money loses value sitting in the bank. You put $1,000 in your savings account today. You check back in 10 years. The number is still there. $1,000, maybe a little more if you're lucky. But here's the thing, you're poorer than you were a decade ago. The bank didn't steal from you. Nobody touched your account. The money just evaporated slowly, quietly. While you weren't looking, this isn't a glitch. It's the design. Let's rewind to 1980. You walk into a bank with $10,000. You open a savings account. The banker smiles and tells you you'll earn 14% interest annually. 14%, you do nothing, and in 5 years your money nearly doubles. You buy a car with the interest alone. Fast forward to today. You walk into that same bank with $10,000. The rate, 0.4%, less than half of 1%. In 5 years you've made $200. You can't even buy new tires. But wait, it gets worse. Because while your money sat there growing by pennies, inflation ran at 3% annually. Some years higher, that $10,000 you deposited, it now buys what $9,000 bought when you started. You didn't lose money on paper, you lost purchasing power, you lost time. You lost the ability to buy the same bag of groceries, the same tank of gas, the same anything. The number in your account stayed the same. The value behind that number dissolved. So why does this happen? Start with what a bank actually does with your money. You deposit $1,000. You think it sits in a vault with your name on it. It doesn't. The bank is legally allowed to keep only a fraction of it, sometimes as little as 10%. The rest, they loan it out to someone buying a house, starting a business, financing a car. They take your $1,000 and lend out 900 of it at 5% interest. You get 0.4%, they pocket the difference. It's not a scam, it's fractional reserve banking. It's been the system for over a century, but here's where it turns strange. When the bank loans out your $900, that money doesn't disappear from your account. You still see $1,000. The borrower now has $900 in their account. Suddenly, $1,900 exists in the system where only $1,000 existed before. Money was created, not printed, created. Out of debt, this happens millions of times a day across the entire economy. And every time it happens, the total money supply grows. More dollars chase the same amount of goods. Prices inch upward. Your savings buy less, you're not earning interest. You're being quietly diluted. Now add the central bank. When the economy slows, the Federal Reserve steps in. They want growth, they want spending, so they lower interest rates, they make borrowing cheaper, they flood the system with liquidity, more loans. More money creation, more inflation, and your savings account. It's not part of the plan, your collateral damage. Between 2008 and 2021, the Fed slashed rates to near zero. They printed trillions of dollars through quantitative easing. Asset prices soared, stocks doubled, real estate exploded, but your savings account earned nothing. Literally nothing in real terms. After inflation, the people who owned assets got richer. The people who saved cash got poorer, silently. Mathematically, inevitably. Let's put a face on this. Meet Sarah. In 2000, she graduates college and saves $10,000. She's responsible. She doesn't invest because she doesn't understand stocks and doesn't want to gamble. She keeps it in a high-yield savings account. It feels safe. By 2020, her account has grown to $12,000 thanks to compounding interest. She feels good until she tries to use it. In 2000, the median home price in the U.S. was about $160,000. Her $10,000 was 6% of a down payment. In 2020, the median home price was $330,000. Her $12,000, less than 4% of a down payment. She saved more money and lost ground. Her discipline was punished by the system itself. Now meet David. Same year, same $10,000. David buys $2,000 worth of Apple stock and puts the rest in an index fund. He doesn't touch it. By 2020, his Apple shares alone are worth over $400,000. His index fund, another $100,000. He didn't work harder than Sarah. He didn't get lucky with a lottery ticket. He just put his money where the system rewards you for participating, in assets that inflate along with the money supply. The gap between them isn't about intelligence. It's about understanding the game. And here's the cruel irony. Banks advertise savings accounts as safe. And they are if your only fear is losing the nominal number. But they're catastrophically unsafe if your goal is preserving value. They're a slow burn, a guaranteed loss in disguise. Meanwhile, the same banks borrow your money at 0.4% and lend it back to you as a mortgage at 7%. They profit on both ends while inflation eats your deposit from the inside. You're not a customer. You're the product. So why do people still do it? Because we're taught to save, taught that cash is king, taught that spending is reckless and investing is risky. And all of that was true once, back when interest rates were high. Back when a dollar tomorrow was worth roughly a dollar today, but that world is gone, the system changed. Savings stopped working, but the advice didn't update. So millions of people keep doing what their parents did, wondering why it doesn't feel like it used to. Here's the bigger picture. Inflation isn't some natural disaster, it's a policy choice. Governments prefer it because it reduces the real value of their debt. A country that owes $10 trillion today will effectively owe less in real terms a decade from now if inflation runs hot. It's a hidden tax. You don't see it on your paycheck, but you feel it at the grocery store. And every time they stimulate the economy, every time they cut rates and print money, they're making a trade. Short-term growth for long-term erosion of your purchasing power. Your savings are the sacrifice. There's no villain here. No conspiracy, just incentives. Banks are incentivized to lend. Governments are incentivized to inflate. Investors are incentivized to buy assets. And savers, they're incentivized to feel responsible while getting quietly destroyed. The system doesn't want you to hoard cash. It wants you to spend it or invest it, because spending drives growth, and growth drives everything. Your savings account isn't part of that equation. It's a relic, a comfort blanket, a place to park money temporarily while you figure out what actually protects you. So what's the answer? That's the question nobody wants to hear, because the answer isn't simple. It's not buy this stock or switch to crypto or move to gold. It's more uncomfortable than that. It's realizing that the rules changed and nobody sent a memo. It's understanding that cash is no longer a store of value. It's a medium of exchange, a tool, not a destination. It's accepting that preserving wealth in the modern economy means taking some level of risk, some level of exposure to assets that move with inflation instead of against it. But here's the part nobody talks about. Most people won't do it. They'll keep saving, keep trusting the account, keep believing the number is what matters. And in 10 years, they'll check their balance, see that it's still there, and feel a little poorer without knowing why. Because the money didn't disappear, it just stopped meaning what it used to.